Six types of assets. Assets might be physical or intangible, now for sale or for long-term sale, or utilized in the day-to-day running of a firm. A company's equity, solvency, or financial health may be calculated by deducting its liabilities.
That is, outstanding obligations or accounts payable from the entire value of its assets.
Here are the six types of assets. Number 1. Current assets. Cash and cash equivalents, accounts receivable, inventories, and different prepaid costs are examples of current assets. While cash is simple to value, accountants must review the recoverability of inventories and accounts receivable on a regular basis. Accounts receivable will be impaired if there is evidence that they may be non-collectible. Alternatively, if merchandise becomes outdated, businesses may write off these assets. Number 2. Fixed assets. Fixed assets such as plants, equipment, and buildings are long-term resources. An adjustment for fixed asset aging is done based on periodic charges known as depreciation, which may or may not reflect a fixed asset's loss of earning potential. Generally accepted accounting rules allow for depreciation in two ways. The straight line technique implies that a fixed asset loses value proportionally to its useful life, whereas the accelerated method considers that the equipment loses value more quickly in the early years of use. Number 3. Financial assets. Financial assets are investments in other institutions' assets and securities. Stocks, sovereign and corporate bonds, preferred equity, and other hybrid instruments are examples of financial assets. The value of financial assets is determined by how the investment is classified and the motivation behind it. Number 4. Intangible assets. Intangible assets are financial resources that do not have a physical existence. Patents, trademarks, copyrights, and goodwill are examples of intellectual property. Intangible asset accounting changes based on the kind of asset, and they might be amortized or assessed for impairment each year. Number 5. Operating assets. Any assets that produce money via day-to-day business operations and aid in the maintenance of workflow. Copyrights, licenses, inventories, and machinery are examples of functioning assets. Number 6. Non-operating assets. Any object that possessed by a firm that create money but are not required for day-to-day operations, such as unoccupied property or short-term investments.
That's all for today's video. Let me know your thoughts in our comment section. Like, share, and subscribe.